Your parents lied to you. Your real estate agent lied to you. And the bank? The bank is laughing at you. Not because buying a home is always bad, but because you were never given the full picture. You were handed a script and you memorized it without ever questioning who wrote it. Today, we burn that script down, and we replace it with math. Here's a number that should terrify you. The average American homeowner believes their home is their single greatest investment. But Nobel Prize-winning economist Robert Shiller studied over a century of housing data and found that after adjusting for inflation, real home prices have returned less than 1% per year. Less than 1%. Meanwhile, the S&P 500 has returned roughly 7% per year after inflation over the same period. So why are we still treating a house like a retirement plan? There are two kinds of people watching this right now. The first person is renting, and every time a friend posts a "we got the keys" photo on Instagram, they feel it. That quiet shame. They've been told they're throwing money away, that they're financially immature, that they need to grow up and buy. The second person already bought, and they're quietly wondering why they don't feel rich, why the mortgage payment is higher than the rent was, why the water heater just died and it's their problem, why they feel stuck. This is for both of you, because the lie was never renting versus owning. The lie was that there's a universal right answer. Stop. Before we go any further, we need to kill the most dishonest phrase in personal finance. Rent is throwing money away. Repeat this with me. All housing is an expense. You pay to sleep somewhere. That's it. The question isn't whether you're spending money, you always are. The real question is, which arrangement builds you more wealth over time? And the answer is not what you think. Because here's what nobody counts when they say rent is wasted. Let's say you buy a $600,000 home at a 7% interest rate. Your monthly payment is about $3,200. Here's the part nobody puts on a billboard. In month one, about $2,800 of that goes to interest. Only around $400 reduces what you actually owe. The rest? Gone. Paid to the bank. That's not equity. That's rent. Rent you're paying to the bank. And it gets worse, because mortgage interest is just the beginning. Add property taxes, around 1.1% nationally. On a $600,000 home, that's about $6,600 per year, roughly $550 per month. Homeowners insurance, $150 to $300 per month. Maintenance? The industry rule of thumb is 1 to 2% of home value annually. That's $500 to $1,000 per month. And that's not renovations. That's the roof, the HVAC, the plumbing, the thing that breaks at 11 p.m. on a Sunday. Add it all up. You're looking at $4,000 to $4,500 per month in costs that build zero equity. Now tell me again, who's throwing money away? I can already hear the comments. But my parents bought for $150,000 and sold for $800,000. Yes, that story is real. But there are two things hiding inside that number, and they change everything. First, inflation. If your parents bought in 1990 for $150,000, that $150,000 is worth roughly $360,000 today, just from inflation. So the real gain isn't $650,000. It's closer to $440,000 over 35 years. Still good, but far less dramatic than it sounds. Second, leverage. When you buy a home, you use other people's money. You put $120,000 down on a $600,000 house. If it rises 10%, that's $60,000. You just made a 50% return on your $120,000. That's leverage. And that's why home ownership has worked for millions. But leverage cuts both ways. In 2008, millions of homeowners found out what leverage does on the way down. Prices fell 30%. People who put 10% down suddenly owed more than the house was worth. They couldn't sell. They couldn't refinance. They couldn't move. They were trapped. The stock market also crashed, nearly 50%. But homeowners could hold. Homeowners were anchored. There's one metric professionals use that almost no first-time buyer knows: the price-to-rent ratio. Take the home price divided by annual rent. $600,000 home, $2,500 per month rent, that's $30,000 per year. 600,000 divided by 30,000 equals 20. Here's what it means. Below 15, math favors buying. 15 to 20, toss-up. Above 20, math favors renting. In many major cities today, it's between 25 and 40. When the ratio is 30, you're paying 30 years of rent, before interest, before taxes, before maintenance. Here's the strategy. Rent and invest the difference. Yes, most people won't. Most people will spend the difference on lifestyle upgrades. That's real. But forced savings only works if you stay. The average person moves every 8 years. When you sell after 8 years, you pay agent commissions, closing costs, moving costs, and you spent the first few years paying mostly interest. Run the real numbers on an 8-year hold, and in many markets, the renter who invested the difference comes out ahead, or even. Here's something else to consider. Switching jobs by relocating often increases salary 15 to 25%. If you're making $80,000, that's $12,000 to $20,000 more per year. Every year. For decades. The renter who can move in 30 days can chase opportunity. The homeowner has to think about listing timelines, market conditions, and 6% commissions. Let's talk about friction. Buying costs 2 to 4% upfront. Inspection, appraisal, title, origination, closing. Selling costs 8 to 10%. Commissions, repairs, staging, concessions. On a $600,000 home, that's $50,000 to $60,000 in friction just to enter and exit. Your home needs to appreciate 10 to 15% just to break even. Not to win, to break even. There's also the lifestyle tax. Homeowners spend about 2.5 extra hours per week on maintenance. That's 130 hours per year. Over 30 years, nearly 4,000 hours. What's your hourly rate? If it's $50 per hour, that's $200,000 worth of your time. Now, some people love that. They love projects. They love roots. They love permanence. That's valid, but it's not free. So when does buying actually win? When you're staying 10 years or more. When your price-to-rent ratio is under 18. When you have 20% down. When your total payment is under 28% of your gross income. When you have a 6-month emergency fund separate from your down payment. If you check those boxes, buy. Buy confidently. Let's talk taxes. When you sell a primary residence, you can exclude up to $250,000 in gains if single, $500,000 if married. Tax-free. Sell stocks with a $250,000 gain? You might owe 15 to 20% in capital gains tax. That's a real advantage. But here's the uncomfortable truth. Rent and invest the difference is mathematically powerful. Behaviorally, most people won't do it. The mortgage is a forcing function. It's automatic, non-negotiable. For people who struggle with discipline, that structure builds wealth almost by accident. Know yourself. So what's the real answer? Stop treating this as binary. In your 20s, in an expensive city with a flexible career, rent aggressively, invest aggressively, build liquidity. In your 30s, with stability and a reasonable price-to-rent ratio, buy. Lock in your payment. Let inflation erode it over time. In your 50s, with a paid-off home and a portfolio, you probably played it right. One more thing. Everyone who tells you buying is always better gets paid when you buy. The agent, the broker, the title company, the inspector, the furniture store. Nobody gets paid when you rent. That doesn't make them evil, but incentives matter. Here's the big reframe. A home is not a stock. It's not a bond. It's not a retirement account. It's a consumption asset. You consume it for shelter, comfort, and belonging. That has value. But consumption is not investment. Buy because it fits your life. Rent when the math doesn't. In both cases, invest consistently. That discipline, not the deed, builds wealth. Before you go, do one thing. Look up the median home price in your city. Look up the rent for a comparable property. Divide price by annual rent. If it's below 15, seriously consider buying. If it's above 20, seriously consider investing the difference. If it's between 15 and 20, run the numbers for your situation. The script your parents followed worked in their era. Different rates, different markets, different economy. You live in this one. And the most powerful financial move you can make is to think for yourself. The dream isn't a 30-year mortgage. It's freedom. Freedom to choose on your terms. Run the numbers, trust the math, and don't let anyone tell you there's only one right answer.